Well, good morning, everybody, and welcome to our latest wealth webinar. My name is Craig Butler. I'm Head of Wealth Management here at Thomas Carroll Independent Financial Advisors. Wherever you're watching from today, I hope you're staying safe and well. I'm joined on today's webinar by Chris Fleming. Chris is Investment Services Director at Square Mile Investment and Research. Chris has a fantastic picture there. Thank you, Chrissy, who's looking after our IT in the background. Keep meaning to change my profile picture. Note to self. So Chris is Investment Services Director at Square Mile Investment and Research. He has over 20 years experience in the profession and, amongst other things, sits on the Tactical Asset Allocation Committee at Square Mile. So what are we going to cover today? So we're going to start with a review of investment markets in 2020. That's going to lead us into a discussion around the performance of the TC Wealth Management portfolios. So the Thomas Carroll Wealth Management portfolios are a range of portfolios that we launched last year. And in a second, I'll just explain a little bit about why we launched those portfolios. Chris is going to take us through some of the key actions that Square Mile took in 2020 in what was obviously a very turbulent investment background. And then we're going to have a discussion about what we expect to see in 2021. We're going to ask for your thoughts there as well, so there will be a poll, so please continue to listen. Chris and I are very keen to answer any questions that you might have. So for those of you that have joined a previous webinar of ours, you probably be familiar with the panel. But for those of you that are new to our webinar, there is a question facility on the panel. So please do send your questions through, and Chris and I will do our best to answer the questions during the webinar. If we can't answer them during today's session, then I will come back to you personally with a response. So a little bit of housekeeping. We expect today's webinar to last around 45 minutes. The webinar is recorded, so for anyone that does need to leave early, you will be able to view a recording of the webinar later today. I just want to draw your attention to the panel as well, and you'll notice there's a couple of handouts. Following feedback from our last webinar, you told us that you were really keen to have some information to take away and review following that. So we've put together a couple of handouts that you can download, and Chrissy will also be sending those handouts to you later with a copy of the recording. As I mentioned, if you do have any questions, then please do pop those in the question box, and Chris and I will do our best to answer those. We'll send you a short survey following the webinar. If I can ask you to complete the survey, that would be much appreciated. Your feedback is absolutely vital to us, and it helps us to shape future webinars and ensure that we are adding value. So I mentioned that we launched our Thomas Carroll Wealth Management portfolios last year, and I just wanted to explain a little bit about the reasons for that. So our role as your financial planner is to work with you to build your financial plan. Now, your financial plan should be very much based around your goals and your long-term objectives. And ultimately, the plan should be there to help you get to where you want to be in the future. Within the recommendations of our financial plan, we always start with the structure. And what I simply mean by that is we think about the types of products that you should be invested in, whether that's maybe pensions or ISAs. And for most of our clients, it's likely that that would be a combination of the two. Once we have the structure right, what we then need to think about is the underlying investment strategy. So we need to think about the risk that we're taking within your portfolio. And depending on our client's needs or your needs, that investment strategy will vary from client to client. What we do know is that for some clients, the right strategy is to hold a collection or portfolio of funds. Now, when we're building a portfolio like that, there's a couple of really important factors to take account of, some of them quite obvious. The first factor being, what funds should we hold in a portfolio? So that's thinking about the performance of a fund, maybe the cost of the fund, the investment theme of the fund. So there's quite a lot of research that goes into what fund should we hold. If we're holding a range of funds, the next important factor is to think about the asset allocation or how they blend together to ensure that the overall risk meets your investment objectives. And then any financial plan obviously needs to be reviewed on a regular basis. And that includes reviewing the underlying investment strategy. So that's thinking about the funds that are in there, in that portfolio. Are they still fit for purpose? Are they still right for your circumstances? So last year, we started engaging with lots of different investment providers. And obviously, as independent financial advice, we have the whole of the market available to us. And that led us to a discussion with Square Mile. We were particularly attracted to Square Mile because they are an independent research company. They don't run their own funds. And for us, that was really important as independent advisors because that sits with our core belief of ensuring independence and a lack of bias. Some of the things that attracted us to Square Mile were simply their investment research capability. So to give you a couple of numbers, last year, Square Mile held 748 fund manager meetings. They reviewed and researched 1,464 funds. So this is a research capability that a wealth management practice such as ourselves just wouldn't be able to do. So Square Mile really help us with the building and the running of our portfolios. And it's, I'm pleased to say, it's a partnership that has worked well over the last 12 months, and I'm sure will continue to flourish. And hopefully for those of you that are currently invested in our portfolios, Chris is going to give you some good news about some of the things that have happened. As I said, the portfolios are right for some clients, and this is part of our investment proposition. So you've probably heard enough from me for now, and I know I could do with a little sip of water. So I'm going to hand over to Chris to introduce himself, and you can start with a review of investment markets in 2020. So Chris, over to you. Thank you.
Brilliant. Thanks, Craig, and hello everyone, and I hope you're all doing well. Yeah, Craig's given a little bit of an introduction about me, but effectively I'm one of the 3 portfolio managers at Square Mile who look after the portfolios, and really what we do is we take all the funds from the underlying analysts and build and construct the multi-asset suite of portfolios that you'll see. And we run 5 of those on a sort of accumulation basis, if you like. But heading over to what happened in 2020, which is a year I'm sure which we would all rather forget, and it's gone incredibly quickly for some strange reason, even though that for a large majority of it we've been able to do very little in terms of our normal life. But I think to start the conversation about what happened in 2020, just to give a bit of context about how 2019 actually panned out, and actually it was an incredibly lucrative year for investors, with all equity markets producing double-digit returns for 2019. And we saw the UK market be up 20% and the US market up 25%. So actually within the portfolios, we actually entered into 2020 being marginally holding less equity holdings in the portfolios and less risk therefore than what we had done historically, because we felt that whilst it's nice to have all those returns, some of the earnings expectations from certain parts of the market were a little bit staggering, and we felt a little bit anxious about that. So just dialed back the amount of equities we held. Now, as it turns out, we then go into Q1 and we have this virus announcement, which completely spooked the market. What everyone had originally thought was going to be just another Asian problem actually become a global problem. And I'm pretty sure that most people thought this was going to be contained before escaping around the world, and still is today, sadly. But entering into the year, we were therefore a little bit less equity holdings in the portfolios, and that actually helped the portfolios when the sell-off occurred, because we didn't have the full amount of exposure that we once would have had. Now, no one could have predicted what happened in Q1, and I'm certainly not claiming that we foresaw this coming, although I did go to a conference at the end of 2019. It wasn't a conference, actually a dinner with a dozen of us, and the chief investment officer from a large global house did actually say that what was likely to end what had happened to be the longest equity rally on history from 2007 and 8 and the credit crisis through to the start of 2019, what was likely to end that was going to be an exogenous event of some description. Exogenous meaning something outside of the financial system, like a war or a pandemic. I wish I'd taken him up on that at the time and put a little more credit behind what he had said, but it was quite interesting when I look back on that. But it certainly did end this historic rally, which we'd seen, this fantastic rally, which had gone on in the equity markets since 2007 and 8, and everything had just continued to trail up, and we weren't used to really seeing much in the way of a magnitude of a drawdown, and it was due to be some sort of, I wouldn't say correction, but a shock in the market. Now, when you look at all the historical events, these typically happen once in a decade or something like this, and this is clearly an extreme event, but and I'm not saying for any second that we foresaw this coming or the magnitude of it. I've got a slide here which actually shows this magnitude of volatility that happened in the market. Now, the slide we're going to show is something it's based on, it's a volatility index. Now, that's not the returns from the market, it's actually the index itself. I'll just wait for it to come up. Yeah, here it is here. And what you can see there are some large spikes along this bumpy road, if you like. Now, on the far left-hand side, some of you may recall that in 2000 and 2001, we had an event which was a tech bubble. So this is when we had a lot of the tech stocks in the US being brought up and basically penny stocks and people trading them up. But actually what ended up happening is all those tech stock and companies didn't have any financial assets behind them. So it was a massive bubble that got overblown and sold off quickly when it all became apparent of what these companies actually owned. Then we have 2007, 2008, the spike in the middle. Well, that's the great financial crisis as it's labeled now. And we see that level of volatility in the market went through the roof at that stage as well. And then the final one, which I'll draw on, is the far right-hand side of the chart. And you can see the magnitude of the volatility that entered into the market in the end of Q1, basically in March. And that's when it became apparent that what was occurring in Asia was now in Europe and was probably merely making its way around the UK as well at the same time. So that, news created a massive sell-off in the market, and the FTSE 100, which is our local market and the one that we use as a bit of a bellwether, was trading at a level of about 7,700 at the time, sharply fell down in a matter of a week or so below 5,000. So that's almost a 40% hit, which happened in the space of a couple of weeks, and that really was what I've been describing as the eye of the storm. Nobody really knew exactly the full extent of how long this was going to go on for, and actually all assets during this period sold off in an incredibly fast and rapid pace, and describing it as probably the worst sell-off that we've ever seen in the financial markets, even outperforming the sell-off, if you like, in 2007 and 2008. However, it wasn't just equity that sold off, actually, and I know that's the main focus of a lot of portfolios. It was the entire market. We saw bond markets sell off, and credit, corporate bonds that are issued by companies, their values plummeted through the floor. We even saw for a very short time gilt markets fall in value, and the US Treasury market. So bonds that have been issued by perceived safe havens sold off. Now, that was a bit of an anomaly because those assets are normally your defensive hedges in a circumstance like this, and them selling off to the degree was quite startling. Now, what turned out to happen was that everybody was thinking, this is another credit crisis event. We need to shore up as much cash as we possibly can, and ran around and sold every financial asset they had to get cash to put on their balance sheet so they could keep running their companies. Now, in the case of the gilts and US Treasuries, that was pretty short-lived as people realized that we weren't dealing with a credit crisis anymore at this point in time. This is not 2007 and 2008. The banks are well capitalized and funded. This is just a mere pandemic. So the safe haven assets then came to their fore and helped support portfolios after that initial sell-off, and once investors started to quickly realize that we weren't going to have a liquidity crisis like 2007 and 2008. So that was what happened in the first half of the year. We then move into sort of Q2, if you like, and just at the end of Q1, actually, the losses in the UK market were of the order of 25% is where they ended up settling. And but in Q2, the economic reality really hit home, and we saw the GDP figures come through for the first time about the impact of what was happening. And we saw within the UK that the economy contracted by about 20%. However, the market continued to rally. If we just move on to the next slide, and it's just showing you exactly what happened within the local market within the UK. So you can see this chart is showing you the returns for £100 invested at the start of 2020. And if you invested purely in the UK equity market, that would have fallen below £70 in a very sharp period of time. You'll then see a quick spike up, and that is when the market recovered and thought, you know what, we're going to get over this virus. We're coming into a summer now. We don't believe some of these figures, and the market spiked up quite sharply. And then throughout the course of the summer, it really operated around, it was around about the 6,000 level, but still significantly down from what we saw from the start of the year. So that saw us through the end of through the summer, actually, where the markets rallied and we were a lot more active in our activities. However, by the end of Q3, the summer months, we saw infection rates start to come through in September again. We had the lagged effect contradicting that, however, with the GDP as having a quick spike back. But the UK market really continued to be the laggard relative to the rest of well, particularly the US and Chinese markets. If we look at the next slide, we can see exactly what I mean. So we've seen the UK market bounce along there for a period of time until the final of Q4. If we just show you the next slide, I'll show you what happened within the US market. So this is the US market, which is the red line here. So it had the immediate sell-off as well. Not quite as severe as within the UK, but they went through a higher starting point through February, as tech stocks continued to do their thing in the States. But you'll see the sell-off that happened, and then it bounced back quite sharply as well. However, unlike the UK market, the US market continued to rally all throughout the entire year. Now, that is good for investors if we're participating fully in that market. However, what has happened within the US market, which is different from the UK and actually a lot of the other global markets, is the US market is full of massive tech stocks. And there's 5 stocks particularly, likes of Amazon, Facebook, Apple, Microsoft, and there's one other which is slipping my mind, Microsoft, I think I didn't mention. But those stocks rallied through quite hardly as everybody who was operating in a lockdown society relied more and more on these sorts of stocks, and it pushed the US market through the entire year. Funnily enough, the other market which had a strong year like this was, ironically, China. So China also rallied in a very, very similar way to the US market, whilst the remainder of the global markets actually followed a similar trend to the UK. Now, what is interesting about the UK, however, is that it has been the laggard in global markets for 5 years now. If we look at the returns over a 5-year period for the UK market, it has returned 28 or 29%. If you compare that relative to the US market, it's more like 112%. So the reasons for that is, Brexit has slowed it down. It's also the construct of the UK market is heavily involved in financials and oil and gas and energy stocks, and all of those sorts of stocks, especially during 2020, struggled quite a lot, especially relative to these tech stocks that you see, which make up actually 25% of the US market. So 5 stocks make up 25% of the US market, and they drove all of these returns. If you took those returns out of the US market, that red line looks a lot like the blue line. That's how significant their impact has been on the US market itself. However, rolling into Q4, infection rates start to go up. We end up again in a lockdown place. However, the financial markets and equity markets took no notice of this whatsoever, and Q4 actually happened to be one of the strongest quarters of returns for quite some time, and UK equity market actually rallied 10% during that quarter, which you can actually see on this blue line. If you look at that final segment from that rally up, that shows the rally within the UK market during that period of time. And actually, for the first time in 5 years at least, the UK market outperformed the US and outperformed basically every other market except the emerging markets. Now, what was the catalyst for that is actually quite interesting. You may recall, even though it is easy to lose track of time at the moment, I must admit, that 3 significant events happened during Q4. One was Brexit happened right at the very end, so that paved the way and provided a bit of clarity within the UK. We got a deal, whether you like it or not, that deal was done, and time will tell how successful that deal will be. However, there will be further negotiations as time passes. The second point was we had an election in the US, and Biden got in power, and we've seen the impact on that, especially within the tech stocks, as his view on these stocks is that these guys have too large a monopoly on the market, and there's what's called an antitrust legislation that he's trying to push through, which may look to break them up a little bit. And also he's pro-spending at the moment as well, which probably means greater financial stimulus into the markets, which might be a good thing, but the longer term is there'll be more debt to pay back. So that helped the market in the short term in the US, but the tech stocks didn't do much. So the other parts of the market started to do quite well there. And the final point was, well, we got a vaccine announcement. In fact, we didn't get one, we got 3, which came pretty much unexpectedly, unless you'd been following it particularly closely. So all of that actually was a massive tailwind, as we like to say, for equity markets during Q4, and it produced returns of the order of 10%. Now, what does all of that mean for an average multi-asset portfolio, which we show you on the next slide? If we compare the FTSE 100 to what the Thomas Carroll central risk portfolio, it's the balanced, it's the medium portfolio. You can see here the comparison of returns. So the blue line again is what we saw with the FTSE 100. However, we can see if you're £100, it started at the year, we had the sell-off, and then because we've gained access to all these other international markets and just don't focus on the UK, so we have exposure to the US, we have some exposure to emerging markets, we have some corporate debt in there as well, we have some US treasuries, we have Asia Pacific, we have all these other regions in this portfolio. We can see that that's actually weathered some of the storm which we've seen purely from the UK equity market. And this particular fund, which is a balanced one, or the medium one I'm referencing our benchmarks, is turned out to deliver 5% over the course of the year, which, if you look at expectations from market pundits, which we receive a lot of from the likes of Goldman Sachs and JP Morgan, an expectation for an equity portfolio, which this isn't. This portfolio's got about 65% equities and 35% bonds. An expectation for equities would be of the order of 5 or 6% in a given year. So actually, given all the noise and the roller coaster we've all been through, the portfolios have weathered the storm, and we've ended up around about what one would expect from a balanced portfolio in an average year, if I'm honest. So,
Chris, Chris, I'm sorry to cut across you.
No, that's what I was going to say. That sums it up.
Wow. Oh, great. Thanks. I'll let you take a sip of water. We chose to just demonstrate the performance of our Thomas Carroll medium portfolio on the screen, just to sort of keep things nice and tidy, I suppose, and not have some messy slide with all 5 portfolio returns. But I suppose just in a few words, your thoughts on the 2 portfolios that sit at the lower end of the risk scale and both at the higher end.
So the journey is very, very similar. If I was to put these lines across there, the more equities that are held in the portfolio, the rockier that road has been from left to right, and the more that it'll represent what's happened in the UK equity market. They all have ended up above that, and actually, as it turns out, they've all returned between 4 to 5%, actually. So quite a flat level of return across the lot. Now, over a longer time period, I would expect the portfolios that hold more equities in them to actually deliver more. but the road along the way will just be a little bit bouncier, because investment philosophy states that if you're taking more risk, you want to be rewarded with a greater return effectively, and that's what happens with an equity market. But what has made the lower risk portfolios, if you like, which hold more like 60 to 70% bonds in them, is that during that sell-off, the UK gilt market actually returned 7% in a matter of 3 or 4 weeks, and actually returned 8% over the entire year. Now that's a phenomenal return from a boring government issued bond. And it's because people rushed out of equities and brought the gilts, if you like, during the immediate sell-off. And if I had a chart here which showed the returns of bonds, you would see a massive spike in around the April time period, but actually pretty flat then for the rest of the year, as what is known as the yields get tighter, which means the prices have gone significantly up, and then it stays quite stable for the next 6 months until we see it's fallen in value a little bit lately. So that is why we're seeing the lower risk portfolios actually deliver a return of about 4 or 5%, very similar to actually where an equity market focused fund would do as well, because they didn't have such large dip, and gilts have built that up quite a lot, or bonds in the portfolio.
Yeah, great. Thanks, Chris. I think what this slide demonstrates as well is certainly the conversations that we've had between Thomas Carroll and Square Mile over the last 12 months during our investment committee meetings, which was very much around managing risk and volatility. And I think we can see that bearing out through the slide there with the returns from the TC Wealth Management medium portfolio. Right, now, Chris, we're going to come on to talk about some of the key actions that you took, but I'm going to put our audience on standby here, because after you've covered your 3 key actions that Square Mile took last year, we're going to ask the audience for their views, and there's going to be a poll coming up. So for those of you that are still with us, and we have a lot of you on the call today, there's a poll coming up very, very soon for you to get involved in. So, Chris, you've given us a fantastic overview from a macro perspective as to where 2020 took us. Just tell us, in a little detail, some of the key actions that you were taking last year at Square Mile.
Yeah, I mean, it was a busy year, and we if you like, traded the funds a lot more than a typical year. For example, I think we had 8 different instances where we sat down and actually traded across the portfolios, and a typical year might be a couple. That's all average stuff. But one of the things I mentioned in the intro I gave about 2020, we held a bit more cash in the portfolio than normal, which did protect the portfolios when it sold off, thankfully. But we did build that up a little bit more, because one of the things that happens when the markets go through a shock like this is liquidity, and we had to be conscious of liquidity in the portfolio and be ready to make our investments when the appropriate times happen. So we brought a little bit more cash temporarily in the portfolio to be prepared to make those purchases. We sold a couple of the bond holdings in the portfolios, which we felt had become a little bit more correlated across the markets than we wanted. But really what we wanted to do was extend this concept called duration in the portfolios, which is really the interest rate sensitivity in the market. So we realized that there'd been a big sell-off, but we wanted to get access to some of the bonds who had, when things we felt had oversold, if you like. So we were in a position to buy them, and we made a position of about 7% in what you'd call a corporate bond fund, a core position in that. And actually it is what you call done quite well. It's returned over the last 9 months, or actually more like 6 or 7 months, has been held in a portfolio. The final thing that we did really was have a couple of nibbles at buying back into UK equities with the cash as well. So we did one of those in the end of September, and then another one at the end of October. We did a lot of work into this, and we felt that the UK equity market has been unloved for quite a long time, and there were certain parts of the market that were too unloved, if you like, and the ratios and the valuations on those were very attractive. So we made in total about a 5% allocation between those back into UK equities, and actually it wasn't a bad time. We don't get things right all the time, but I think the timing of getting back into UK equities wasn't too bad, and we've benefited from that during Q4 and it's it's been a bit more flat actually in Q1. So the three actions were really raised a bit more cash because of liquidity and give us buying opportunities. We bought the corporate bond funds because of the duration impact, and we also added 5% to UK equities along the way. So the other three core ones. There's lots of periphery ones that happen in between that, but other main ones.
Yeah, great. Thanks, Chris. So, we took an overweighted position in the portfolios from a cash perspective, which, we spoke about throughout the year last year. And, that's a decision that certainly paid off for our clients from the point of view of reducing volatility and risk in the portfolios. What other instruments or vehicles did you consider as an alternative to cash? So gold is an asset class that our clients frequently talk to us about. We had quite an extensive conversation around gold around September, didn't we? But maybe great for
we did. Yep.
Hear from you on that.
Gold's a tricky asset class because to value an asset class, you typically need a cash flow of some description to be able to determine what you think its appropriate value is. So for equities, it's dividends, for example, is your cash flow payment you get out of it. Bonds, it's a coupon, right? They pay a fixed coupon to you every year as a sort of like an interest payment for lending them the money. Gold doesn't necessarily generate anything like that. So understanding what its true value is very, very difficult. Now, it would have been nice to access it in its purest sense, actually, within the portfolios. It went up 5%, I think, during the entire year. I think I might have that number wrong, sorry. But it's difficult to get access to, if I'm brutally honest, in the purest sense of gold. You really have to go into what's known as an ETF structure to get hold of it. Now, you can buy funds like BlackRock got a gold and general fund, and we did talk to BlackRock at the time and considered purchasing it. But we felt that the underlying equity within that, or the companies out of the gold mining indices, stocks and shares rather, were possibly a little bit overvalued. Now, for the first 3 or 4 weeks after that conversation, that particular fund did quite well. And did rally quite strongly. However, it fell back and it actually ended up from the action where we actually spoke to BlackRock until it was the end of January, the fund was actually down. So it just shows you that the correlation between actual physical gold and what you'll see on the news broadcast and everything to actually the underlying equities that you would buy within a fund, they're not always quite correlated as you'd expect them to be, but they're not, because there's a lot of other things that go on with a company than just the gold price. It's a big part, the big input clearly, but there's other challenges that go along with running a company. So getting access to pure gold is actually quite a difficult thing to do, unless you do an ETF.
Yeah, come on. Thanks, Chris.
One instrument. Another one quickly is absolute return type strategies. We don't have many of them in the portfolio. We think the industry has been a bit poor in that respect, if I'm honest, but we do have one particular fund which has done quite well in the portfolios, and the reason we hold it really is because gilt yields are quite low. We don't think the yields are that attractive. The yields now are about 0.3%. Can they go lower and the prices go up? Yeah, they could do, and a lot of that may depend on whether the Bank of England cuts negative interest rates, but I think they've softened on that discussion for the time being. So the absolute return type vehicles is a bit of a bond proxy, and it has a bit of correlation into the portfolio as well.
Great, thanks, Chris. Well, I think that gives us a really good overview of 2020. So let's think forward now. It's the 4th of February already. I'm not quite sure how we're already at the 4th of February, but we are. So let's have a think about 2021. Now, we're going to give Chris a bit of a breather, and we're going to hand over to the audience. So we have a poll for you coming up. Hopefully it should be on your screen now. What we'd really like to know is, what is your key concern this year as an investor? So maybe it's the level of government debt being accrued as a result of COVID. We hear a lot about that. Maybe the recovery of your pensions and investments, savings rates, or something else. And if there is something else, then please do pop those into the chat or question box, and we can answer those. So we're just going to give you a minute to answer the poll. it's going to be quite interesting to see the responses that we get here. Obviously lots of concern out there. Had a lot of responses in already. There is a common theme coming up, which I'll share with you now. I'm going to give you another 15 seconds, and then we will close the poll. I think what we'll do is we'll have a look at your responses, and then we'll ask Chris for his thoughts, and then we'll talk about where Square Miles thinking is. Right, so we're going to close the poll. So 57% of you are most concerned about the level of government debt that's been accrued as a result of COVID-19. And Chris, certainly a conversation that we have on a very regular basis, isn't it? And
yes,
recovery pensions, 26%, savings rates, 9%, and then something else, 9%. Thank you for your responses. Chris, your thoughts. Are people right to be concerned about the level of debt?
Yeah, it is one of our key concerns currently as well. We've had huge levels of stimulus provided in the UK and also the US. Now, that doesn't necessarily impact us as much, but it might do in terms of some of the funds that are held within the portfolios. Over there, it's in the trillions of dollars that they have issued. In the UK, it's in the billions, and it's typical. It's trillions there and billions here, but it is of key concern. Now, the interesting thing about this is that the debt to GDP ratio, I think within the UK, is about 110%, 120%, which means that effectively, if you look at all the costs and so forth over the expected levels of revenue, then that's not a strong financial position to be in. However, one thing that gives me a bit more comfort about this is that interest rates are so low at the moment. So it's not necessarily about the magnitude of the level of debt which is kicking around at the moment. It's about the serviceability of it. And with interest rates low, then they can continue to pay the debt down via their current revenue flow. I mean, the other thing that the UK government has been quite good at doing over successive years, it's not just Conservatives, but Labour as well, is that when they have issued bonds to service their debt, or to raise the money, I should say, they've done it at a longer duration as well. So they've actually got low interest rates, and some of this debt is actually pushed out quite a long way. So, 15 years, 20 years, for example. And the reason they can do that is because they know pension schemes and insurance companies are willing purchasers of debt at that level. Now, that makes the average level of debt within the UK, for example, to put it into context, of about 13 or 14 years. In the US, it's about 7 years. So unlike the US, the UK has the ability to be able to pay this off at a lower interest rate for longer, and the US has got slightly shorter terms to be able to do that. But they will clearly want to reduce the level of debt down in due course. And the great unknown really at this stage, and the thing which is weighing heavily on our mind at the moment, is what is happening with inflation. We've been in a deflationary environment now for over 12 months, i.e., economy is not working anywhere near capacity. And whilst, most of us are sitting at home and spending money on Amazon and maybe our groceries, and that's about it, a lot of the other spending which happened, which can drive up inflation, just hasn't been happening. However, when the economy starts moving back towards where it ought to be, which might be, let's be optimistic and say mid-spring or maybe into the summer, vaccines start to take effect, possibly it warms up a little bit, the lockdown and all that sort of carry on has helped to slow down this mystical R rate, then inflation might start coming through. And what will happen at that point in time is very interesting to see what the Bank of England will do, because typically what they will do is lift interest rates to try and take the heat out of the market, if you like, of the inflation market, and temper it. Now, markets normally operate quite well. I think the Bank of England's target is between 2 and 3%, and we're not near that at the moment. So we might see inflation start to come back. But if it rallies really, really hard, it's going to be a difficult game for them to play, because if interest rates go up, then levels of debt serviceability might be compounded, and also you might put a squeeze on a buoyant housing market and people's financial costs who have struggled to get through the last 15 months or whatever it's been. It's 12 months, isn't it now, but without full capacity. So it is very interesting how that's going to play out, and I don't have exact answer except to say you're quite right to raise it as a concern, and we are quite mindful of what's happening. Now, what could happen in the markets is that if inflation does come through, you will not want to be holding a fixed interest gilt or corporate bond to much of a degree. You've got to hold some, but especially a gilt, because inflation is not a friend of a fixed interest coupon payment, because it erodes away the purchasing value of that payment. So index-linked gilts, where they link it to RPI or CPI, might become more attractive. Equities might become more attractive then as well, because they typically do well in a more stable inflationary environment. No asset class likes rampant inflation, because equities, a lot of the companies can pass that on to their consumers, if you like. So equities can be a better play to place position. So that's what we're sort of thinking about at the moment. We've got to keep an eye on what's happening with the overall economy, and we don't think inflation will necessarily be a significant event this year, but it's definitely it could be in the longer term.
Okay, thanks, Chris. Well, one of the questions that's come from our audience, I think this might be a question that we'll want to come back to you individually through your IFA. But I suppose this is probably linked to government debt, but one of our audience is concerned about changes to tax regime, and I guess maybe that's as a result of needing to think about ways of repaying the debt. So we'll come back to a questioner on the potential capital gains tax and entrepreneur. I'll say that word. Entrepreneurs really struggle with that. Don't ask me to say it again. We'll come back to you separately via your IFA on that. But Chris, any particular thoughts on tax increases?
Yeah, I mean, I think it's got to happen to some degree. How that manifests itself will yet to be determined, obviously. But they've got a big pile of debt, and they'll want to get it down at some point. Now, what's happened historically is that they've used inflation as a mechanism actually to erode the value of that down a little bit. But they've got to be careful with doing that to some degree, and I'm pretty sure that's what they did after World War II when debt levels soared. They used inflation as a mechanism to erode it away. But taxes will play a part in some level. I'm sure it will. And even UK hasn't. I don't think they've announced exactly what that means or hinted at it. I mean, they're too busy fighting off a virus at the moment, I think. But within the US, and I know we can't draw complete parallels, Biden coming into power, it was one of the reasons why the market sold off a little bit, was because he has said that taxes have got to increase, but he has to get that through the Senate yet. I know that's not relevant necessarily for us, but it gives you a signal to at least how they're playing that card in terms of getting rid of that debt level. So it's got to happen through increased revenue for the government, taxes, or eroded away a little bit with inflation.
Okay, thanks, Chris. Chris, I'm mindful of time, both for our audience and obviously taking your time. Is there anything else that's particularly on your mind at Square Mile this year that you're mindful of?
No, you've hit the big one, which was the government debt. Actually, we are mindful that we have increased equity holdings, and the equity markets are have been relatively buoyant, but it's really about the earnings of the underlying companies that come through now. And if the earnings don't come through as expected, which is quite often what the markets are, the forward-looking expectations, those earnings don't come through, then we might see a few wobbles throughout 2021. So we're mindful of that. That's the main one, alongside the government debt and the inflation and that large macroeconomic challenge which exists. But they're the key ones. I think it's fair to say that we're going to continue to have a bit of volatility in the market. It's good to have balanced, diversified portfolios of varying degrees of risk taking, i.e. how much equities are within them. It's up to everyone's individual requirements, I guess, but we could expect a couple of short, sharp sell-offs again. And whenever I sort of have this analogy that it's like a tightened up rubber band, and that if you bang it sometimes, it might spring up and then spring back down and contract quite quickly. So I think, and that's what happens when it's in a highly sensitized state. And I think we're still in that state for the time being.
Super. Thanks, Chris. Right, I'd just like to spend a minute or so thinking about future webinars. So this is going to be another poll for our audience. Our last two webinars have very much focused around investment markets, where things have been, where things are going. We'd like to think about offering you something different for our Q2 webinar, which we're thinking about holding around May. One of the subject areas that we've been discussing at Thomas Carroll Wealth Management is that of sustainable investing. Some people may have previously referred to it as ethical investing, or ESG investing if you're keen on researching yourself. So we have a poll here, and we just really like to hear from you very quickly. The poll will come up now shortly. So we'd just like to know, is sustainable investing a subject area that would interest you? And just a simple yes or no, and that will just help us to direct our invites to you for Q2 or not. Chris, I guess just as we're having some responses to the polls, have you got maybe 30 seconds or so just on your views around sustainable investing?
Yeah, it's gathering pace. We've seen significant inflows across the market within the UK over 2020, and globally there's been trillions of dollars that have been invested in sustainable types of investing. I think what's different this time is that back when I was advising to institutional pension schemes, a lot of it was based on ethical investing, which was basically based on exclusion, i.e. we don't want any oil, we don't want any sin stocks, tobacco or anything like that. And it was driven mainly by large schemes. Now it's being pushed by governments, regulators and consumers, and also fund managers. So it's coming across the board now. Whereas, when it was, in vogue before, it wasn't being pushed across all levels. And it's definitely attracted a lot of flows, as I mentioned.
Yeah, super. Thanks, Chris. Okay, so a very positive response here. So 87% of you would be interested in knowing more about sustainable investing. So we will certainly ensure that you are part of the invite list we send out for Q2. Certainly a very interesting subject area, and one hopefully that we'll be able to add value in Q2. So look, we are 4 minutes over. I apologise that we're 4 minutes over, but the good news is that all of the people that started our webinar are still with us. So, hopefully you took value from what Chris had to say. So email address on the screen. So we have got a couple of questions that we will come back to you individually. But certainly if there are any questions, please pop those to us at wealth.management@thomas-carroll.co.uk, rolls up the 10, or you can contact us over the telephone. So Chris, a very big thank you again for your support on the webinar and your thoughts on investment markets. Thank you also to Chrissy, who organises these webinars and does all of the work in the background. So Chrissy, we're very grateful for your help. But finally, thank you all for attending the webinar today. I hope you enjoyed it. Please do give us feedback via the survey, and continue to stay safe and well, and we will speak to you again in the next quarter. Thank you all. Goodbye.
Thanks, everyone. Bye-bye.